when it comes to financing your next real estate purchase, there are a variety of ways to do so. Of course, the most common way is the traditional mortgage. You could rely on private lending. You could purchase the property in cash, or you can use your life insurance policy to help you finance your next real estate purchase. Now, a lot of people don't realize this, and I'm not talking about term life insurance. I'm talking about what's called a tax-exempt whole life insurance policy. So these policies are special in nature. There's two main components to them. Of course, the most obvious point is, yes, they come with life insurance, permanent life insurance. It lasts forever, doesn't expire, doesn't increase in price. You'll have that as long as you live. But that life insurance isn't what helps you purchase your next property, your next piece of land. What helps you do that in these policies is what's called the cash value. And the cash value is the investment part of a tax-exempt whole life insurance policy. So as you put money into these policies, yes, there's a death benefit, but there's also a living benefit. And the living benefit is the cash value. And that's something you should use during your lifetime. I encourage you to use during your lifetime, and that can help you purchase your next real estate property or piece of land. And how it works is, as you put money into these policies, you're giving the money to the insurance company, and they're taking this money and they're investing it into their own portfolios. And some of these portfolios are 30, 40, 50 billion dollars. They're massive, massive portfolios. And really what the insurance company says is, okay, you haven't died yet. If you do die, we're going to pay out your $5 million or $10 million death benefit, or whatever the amount is. That's a guarantee in the contract we've signed for you since you've purchased this life insurance policy. But while you're alive, it's almost like an open door policy. They're going to allow you to get access to these funds to make purchases, to do whatever you essentially want with it. But one thing you can do is purchase your next real estate property. So as you're alive, open door policy, you're able to leverage and use what's in the cash value, what's in the investment for your own purposes. So I'll give you two examples. The first is, let's say over the last several years, you've been putting money into this policy and you've accumulated $1 million in the cash value. So not the death benefit. The death benefit could be 5 million, 10 million, whatever that is, but the cash value is worth $1 million. And the day comes where you need to purchase your next real estate property. Something comes up hot on the market, you need to act quick, and you need, let's say, $200,000 as quickly as possible in a very tax efficient manner. You don't want to have to call the bank. You don't want to have to fill out a bunch of paperwork and go through income statements, 2 years NOAs, things like that. You just need $200,000 very, very quickly and very tax efficiently. Well, what you would do is you would call the insurance company and you would request a policy loan for $200,000 against that policy that has $1 million in cash value. And as long as the policy loan isn't above the ACB, the full $200,000 would be given to you tax-free within 2 to 3 business days, let's say. Very, very quickly. It's a painless process. You don't have to submit 2 years of NOAs and financials and corporate statements and things like that. It is a very, very quick way to get capital when you need it for your next real estate purchase. Now, the other example would be if you needed more than just $200,000. Maybe you needed $800, $900, even the full $1 million, and your cash value is also $1 million. So you're going to make a major purchase. You needed that money, again, quickly, tax efficiently, but you needed a lot more than just $200,000. In this scenario, instead of going to the life insurance company, it might make more sense to go to a third-party financial institution. And what you're going to do is use that cash value as collateral, and they're going to loan you money against the cash value. So just like putting a mortgage on a home, the home is the asset. It's the physical asset, and you're loaning against the asset. In this example, the cash value is the asset. It acts as the home, and you're loaning money against the cash value. So there are lenders who will loan 100% to value, so you can get the full $1 million. There may be some financial underwriting required, potentially some additional collateral to put up, but it is possible. And you would get the full $1 million tax-free. So there's no tax on it. You now have $1 million to use as you please to purchase your next real estate transaction. And again, it's all done through your life insurance policy. So The cash value is what helps you acquire more properties throughout your lifetime. And the life insurance, the death benefit part of these policies, is what will help you keep your properties in your family for future generations. Because if you have secondary properties, if you have rental properties, a family cottage, commercial properties, and there's been growth amongst these properties. So from whatever you've purchased it at to what it's worth, not only today, but what it's worth in the future, when you go to give these properties down to your kids, if there's been growth, that's a capital gain. And half of that becomes taxable in the year of death, and assume a 50% tax bracket for easy numbers, basically half of the half. So 25% of the total capital gain could be owed in taxes. And we're just excluding betterments and improvements just for argument's sake, simplicity's sake. But close to 25% of the total capital gain on secondary properties can become owed in taxes when you pass away and when you go to give these properties down to your children. So I'm not talking about a tax-free rollover where it can roll over on a tax-free basis from spouse to spouse. I'm talking about if both spouses pass away or there is no surviving spouse and the real estate portfolio goes down to the kids and maybe even the grandkids. It's as if you've cashed everything out, you've sold all of your properties, even though you physically haven't sold them, and the life insurance can help pay for these capital gains taxes. So it's kind of a twofold product where it can help you acquire properties during your lifetime, as well as keep the properties in your family on the back end. And the last thing I wanted to mention is a lot of my clients who are in real estate, who are in construction, who are builders, they have large real estate portfolios and they know they have capital gains taxes to deal with. So they need the insurance to keep their portfolios intact when they pass them down to their kids. They don't want to lose 30% of their properties because they have to sell them to come up with the cash to pay for the taxes to keep the rest of them. So they want the life insurance. They need millions and millions of the death benefit to pay for these taxes, but they don't want to be out of pocket the large premiums to pay for these policies. So if they're looking to get $5 or $10 million of insurance and the premiums are, say, $500,000 a year, they can afford to write the $500,000, but they would prefer to have that $500,000 back in their own pocket. So in this strategy, what they're going to do is write that check for the $500,000, put the policy in force, which comes with the $10 million death benefit and the cash value. The cash value exists as soon as you put the policy in force. And what they're going to do is immediately borrow back the full $500,000 to put back into their pocket, back into the corporation, do as they please with that money, but they have the insurance in force. So they might pay interest on what they borrow back. They can maybe capitalize the interest as well, which just means the interest is being owed, but it's just being added to the balance outstanding. But it's a way for people to have the insurance they need, but also get the money back in their own pocket to make their own investments or expand their business or whatever the case may be. So to summarize, tax-exempt whole life insurance policies can be another alternative to financing your next real estate purchase. It can help you also keep your properties for future generations, your children, your grandchildren. And if you wanted to get the insurance but also have your money back, it is a possibility as well. Thanks for watching.